Saturday alert. What just happened to silver changes everything. Something happened this week that most investors completely missed. Not on the front page, not on CNBC, not trending on Twitter, but behind the scenes, in the silver market, a signal just fired that has only appeared a handful of times in the last 50 years. And every single time it did, what followed changed the financial landscape for years. Stay with me, because by the end of this video, you're going to understand something that the majority of investors, even experienced ones, have no idea is happening right now. Let me ask you something. When was the last time you heard a mainstream financial anchor seriously discuss silver? Not gold, silver. They don't. And that silence, that deliberate ignorance, is exactly why this moment is so powerful for those who are paying attention. Today we're going to break down exactly what just shifted in the silver market this week, why it connects to the Federal Reserve, why it connects to industrial demand, and why the math, cold, unemotional math, is starting to point towards something significant. Most people will miss this window entirely. You won't, not after this video. Section 1. What just happened? Let's start with what actually happened. Silver moved this week in a way that deserves serious attention. Now I want to be careful here, because this channel doesn't do hype. We do analysis. But here's what the data is showing us. Silver has been consolidating for weeks, building pressure like a coiled spring. And this week, that coil started to release. Why does that matter? Because silver doesn't move randomly. It moves in response to forces that most retail investors never bother to understand. Forces like Federal Reserve policy signals, industrial demand shifts, the gold-silver ratio, COMEX positioning, and something even bigger, the global de-dollarization trade. All of those forces are converging, right now, simultaneously. That is not normal. That is rare. And when silver gets multiple tailwinds at the same time, historically, the moves that follow are not small. Section 2. The Federal Reserve connection. Let's talk about the Fed, because you cannot understand silver in 2026 without understanding what Jerome Powell's successor is walking into. Kevin Warsh is now sitting in that chair, and the market is watching every word, every pause, every press conference, searching for signals about what comes next for interest rates. Here's what most people get wrong about silver and interest rates. They think rates go up, silver goes down. Rates go down, silver goes up. Simple inverse relationship. That's a beginner's understanding. And it costs people money. The real relationship is more nuanced and far more powerful. What matters is not the absolute level of rates. What matters is real rates. That's nominal interest rates minus inflation. When real rates are falling or moving toward negative territory, hard assets like silver don't just benefit, they historically surge. And right now, look at what's happening. Inflation is not as dead as the mainstream media wants you to believe. We have persistent services inflation. We have energy costs being repriced globally. We have a geopolitical landscape that is structurally inflationary in ways that a single Fed rate cycle cannot fix. Meanwhile, the pressure on the Fed to eventually ease from a $36 trillion debt load that needs to be refinanced is enormous. That combination, stubborn inflation, eventual monetary easing, debt monetization pressure. If these conditions continue, and the historical parallel suggests they will, the environment for silver begins to look extraordinarily compelling. Section 3. The supply crisis nobody is talking about. Now here's where it gets really interesting, because what's happening on the demand side of silver right now is genuinely unprecedented. Think about this. 20 years ago, silver was mostly a monetary metal and a photography metal. Those were the primary drivers. Photography is essentially gone as an industrial silver consumer. You'd think that would hurt silver, but what replaced it dwarfs what was lost. Solar panels, electric vehicles, AI data centers, advanced electronics, defense systems, medical equipment. Silver is not optional in any of these technologies. You cannot substitute it out. It is the best electrical conductor on the periodic table. Period. Full stop. And here's the problem. Mine supply. The silver that comes out of the ground every year has not kept pace, not even close. The Silver Institute has reported consecutive years of structural supply deficits. More silver is being consumed by industry and investment than is being produced. Think about what that means. In a normal commodity market, a supply deficit drives prices higher until new supply comes online or demand drops. That's Economics 101. But with silver, new mines take 7 to 10 years to develop. Demand from solar alone is accelerating. AI infrastructure is creating new industrial silver demand that nobody was modeling 2 years ago. There is no quick fix on the supply side. So ask yourself the obvious question. If demand keeps rising, and structurally it is, and supply cannot respond quickly, what does basic economics tell you happens to price? Section 4. The gold-silver ratio, a powerful signal. Let me show you one more piece of this puzzle, and this one is something most retail investors have never even heard of. The gold-silver ratio. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, that ratio is historically elevated. What does that mean in plain English? It means silver is cheap relative to gold. Historically cheap. Every time this ratio has reached extreme levels, and we've seen this in the early 1990s, in 2003, in 2009, in 2020. What followed was a period where silver dramatically outperformed gold. Not slightly outperformed, dramatically. In 2020, when the ratio peaked above 120, silver went on to more than double in a matter of months. Now, I'm not saying history repeats exactly. It never does. But history does rhyme. And right now, that ratio is sending the same kind of signal it has sent before major silver moves. The smart money, institutional players, family offices, sovereign wealth vehicles, they watch this ratio. They position accordingly, quietly, before retail attention arrives. You're watching this video on a Saturday. That means you're ahead of the crowd that will be talking about this on Monday. That matters. Section 5. The geopolitical layer. There's one more dimension to this story, and it may be the most important of all. De-Dollarization. That's a big word. Let me make it simple. For decades, the US dollar has been the world's reserve currency. Oil is priced in dollars. Commodities are priced in dollars. Countries hold their reserves in dollars. That system is cracking. BRICS nations are actively building alternative settlement systems. Saudi Arabia has discussed oil sales in non-dollar currencies. China and Russia have been converting dollar reserves into gold for years. Now here's the silver connection that almost nobody is making. When confidence in fiat currency, in paper money backed by nothing but government promises, begins to erode at the sovereign level, where does the capital go? It goes into hard assets. Gold first. Always gold first. But gold is expensive. Gold is heavy. Gold is harder to use in industrial applications. Silver is the little brother, the undervalued cousin, the asset with the same monetary heritage as gold, thousands of years of being used as money, but with an industrial demand story that gold simply does not have. As de-dollarization accelerates, and geopolitical trends suggest it will, silver sits at the intersection of two massive capital flows: monetary demand running from fiat, industrial demand driven by the energy transition. That intersection is where significant price moves are born. Section 6. What could go wrong? Now. I want to be honest with you, because credibility matters more to me than views. Silver is volatile. That is not a flaw. It's a feature if you understand it, and a danger if you don't. If the Federal Reserve stays restrictive longer than the market expects, real rates could remain elevated, and that creates headwinds. If global industrial demand slows because of a recession, solar installations get delayed, EV sales disappoint, that removes a tailwind. If the dollar strengthens sharply due to a global risk-off event, commodities broadly face pressure. These are real risks. They deserve respect. What I'm describing today is not a guaranteed outcome. Nothing in markets ever is. What I'm describing is a setup, a confluence of conditions that, if they continue developing along their current trajectory, creates a historically powerful case for silver. Position sizing, risk management, understanding your own time horizon. Those are your responsibilities. This video is analysis, not financial advice. But the setup is real. Here's what I want you to sit with tonight. Silver has been ignored, suppressed in the financial media narrative, treated as a minor footnote while everyone debates Bitcoin and Nvidia, but ignored assets. Assets with real supply deficits, real industrial demand, real monetary heritage, and a real macroeconomic tailwind have a history of not staying ignored forever. The question isn't whether silver matters. The question is, when the rest of the world figures out what you now understand, will you already be positioned? Or will you be watching from the sideline, wondering how you missed it again? That's the choice every informed investor faces right now. Not whether to pay attention to silver, but whether they'll act on what the data is already telling them before the crowd arrives. Think about that, and I'll see you in the next one.